Every dollar you spend, every investment you place, every business you build, behind all of it lies a hidden system, a structure so simple yet so powerful that most people go their entire lives misunderstanding it. Two words, two forces, two pillars everything in finance is built upon. Debit, credit. Not just accounting terms. These are the engines that explain how money moves and what it means for your financial future. Most people fear them. Most people misuse them. But today, it ends. No jargon, no confusion, no overcomplication. Just the truth. Clear, simple, and finally within reach. This is the moment you master the foundation of all finance. Let's demystify debits and credits once and for all. First things first, let's clear up some common misunderstandings. When you hear the words debit or credit, what often comes to mind? Many people might think debit means something bad, like taking money out, and credit means something good, like putting money in. Or debit is subtracting and credit is adding. Let's erase those ideas from your mind right now. In accounting, debits and credits are neither good nor bad, and they are not the same as simply adding or subtracting. Instead, I want you to think of them like the two sides of a coin, heads and tail. They are simply words we use to reflect the fundamental duality, the two-sided nature of every single financial transaction. So, if they are not good or bad, what are they? Here's the core idea. In the world of finance, money, or what we accountants call economic benefits, doesn't just magically appear or disappear. Think about it. If money goes into one account, it must have come out of another. Accountants see every transaction as involving a flow of money. That's economic benefit moving from a source to a destination. Here's the key relationship. Credit represents the source. This is where the money or economic benefit is coming from. Debit represents the destination. This is where the money or economic benefit is going to. It's all about tracking that flow. Every time money moves, there's a source and a destination. Now, let's look at the different types of accounts in accounting and how they can relate to debit and credit. Think of it like this. Debit accounts, that is the destination. These are the accounts that increase when you debit them. Money or economic benefit flows to these accounts. These include assets, things your business owns, like cash, buildings, vehicles, or money that customers owe to you. Expenses, costs your business pays to operate, like rent, salaries, or utility bills. Dividends, when a business pays out some of its profits to its owners. Now, credit accounts, the sources. These are the accounts that increase when you credit them. Money or economic benefit flows from these accounts. This includes liabilities, money your business owes to others, like a bank loan or amounts owed to suppliers. Owner's equity, the owner's investment in the business, and revenue, money your business earns from selling goods or services. To see this in action, let's revisit our core accounting equation. Assets equals liabilities plus equity. We know that assets typically increase with a debit. Liabilities and equity typically increase with a credit. Now, remembering which accounts increase with a debit and which with a credit can seem like a lot. So, I have a super helpful trick for you. It's a simple, easy to remember acronym, DILA. Let's break down what each letter stands for. The D in DILA stands for dividends, E stands for expenses, and A stands for assets. These first three letters, DEA, represent the accounts that increase when you debit them. So think DEA for debit increases. Now, for the second part, L is for liabilities, E for equity, and R for revenue. These last three letters, LER, represent the accounts that increase when you credit them. So think LER for credit increases. DILA, it's your secret weapon for remembering how debits and credits affect different accounts. Alright, we've covered the essentials of debit and credit. Let's quickly recap the main points. Forget the myths. Debits and credits are not good or bad, and not just adding or subtracting. 2. They track the flow of money, that is economic benefits. Credits are the source, and debits are the destination. Use the DILA acronym to remember which accounts increase with a debit and which with a credit. Dividends, expenses, assets increase with a debit. Liabilities, equity, that is owner's equity, revenue increase with a credit. Understanding these concepts is fundamental to mastering accounting. And just like that, debits and credits are no longer a mystery. If this made things clearer, hit like, drop a comment, and subscribe, because we are just getting started. More clarity, more confidence, more mastery of the language of money. See you in the next lesson.